Welcome to Breaking News to Trading Moves. We're here to look at the latest market intelligence and explore what it means for different publicly listed companies. And today we're focusing entirely on the recent earnings results from Alibaba. Now, of course, Alibaba is a huge player in China, but this report gives us a lens on much more than just Chinese consumer habits. It really maps out some global technology trends that go well beyond Asia. So what we'll do is first we'll establish the core facts from Alibaba's performance. What were the key numbers? And, where did that momentum actually come from? And then we'll get into the analysis of which market segments could benefit and which ones might face some increased pressure based on the strategic moves Alibaba just revealed.
That's the framework. And the essential finding here is that Alibaba showed strength in a couple of specific growth areas, which is why their revenue came in ahead of expectations.
Yeah.
And because of their scale, this performance is being used as a kind of litmus test for several global sectors, everything from e-commerce, logistics to, high-end computing hardware. Our whole focus today is to clearly outline for you the mechanism, the why behind these connections. Why are certain companies being identified as potential winners and others as, well, facing some strain after this one report?
Okay, let's get right into it then. Section 1, the headline performance. So Alibaba's top-line revenue. It came in stronger than what most analysts were predicting. But with these massive companies, it's often more about where the growth is coming from than the total number itself. So where did the real momentum originate?
Well, it wasn't spread evenly across their entire business, not at all. It was really concentrated in two areas that represent both immediate consumer demand and, on the other hand, long-term infrastructure investment.
Right.
The first one was what they call one-hour instant retail. And the second, which is strategically very different, was in their cloud and AI services division.
Let's talk about the instant retail side first. This is where you can really see consumer habits in action. This idea of getting things, groceries, household goods, within an hour seems to have been a huge revenue generator. This wasn't just a small increase, right? This was a pretty loud signal from consumers.
It was a very loud signal. And it tells us a few things about, the maturity of the Chinese e-commerce market. First, consumers there now expect extreme convenience, and they expect it to be bundled with exceptional speed.
So an hour isn't a luxury anymore. It's becoming the standard.
It's moving from a novelty to an expectation, yes. And that suggests a high tolerance for the small premium that comes with it. Second, it really validates the incredible complexity of the logistics network you need to pull this off.
You mean all the mini warehouses and delivery infrastructure?
Yeah, exactly. You need these decentralized inventory points, these dark stores, and an extremely efficient, tech-driven, last-mile delivery system. Alibaba's success here just confirms that their huge investment in that logistical backbone is finally paying off in revenue.
And that has implications for competitors everywhere.
Oh, absolutely, as we'll get into.
Okay, so that consumer-facing speed is one engine. But the second one, cloud and AI services, feels like a completely different business. Can you elaborate on that growth driver?
It is a totally different business. The cloud and AI segment is enterprise-facing, it's future-focused. The growth here isn't just about selling, basic data storage. It's specifically tied to the accelerating global demand for advanced computing resources, the kind you need to train and run these large-scale AI models.
So Alibaba is positioning its cloud as more than just storage.
They're positioning it as an AI factory. And the rapid growth there suggests that enterprise demand in China for a domestic, scalable AI infrastructure is absolutely booming, which really just mirrors the trend we're seeing all over the world.
So you have two very distinct and, I imagine, very expensive priorities driving revenue: subsidizing super fast consumer delivery and building out these massive AI data centers. But of course, that success had a cost. Which brings us to the profitability headwind the analysis pointed to. How did this revenue growth end up hurting their overall profit margin?
The trade-off was very clear. While the revenue was strong, the company's operating margin was squeezed. And when that happens, investors immediately start asking, is this intentional?
Is it inefficiency or is it a strategic choice?
Precisely. And in Alibaba's case, the analysis points to a strategic choice, driven by two distinct financial pressures.
And what were those?
First was just the sheer volume of heavy investment expenditures. Capital was flowing out at a very fast pace to build new infrastructure, specifically those data centers for the AI cloud growth. You can't make money from AI services if you're not constantly buying and deploying the latest and greatest hardware.
Okay, that's one. And the second?
The second, and maybe the more aggressive one, was the result of intense price wars within the delivery sector.
Right. Let's break those two apart for a second. The investment in data centers is Well, it's the cost of doing business for future AI revenue. You have to spend that money. But the price wars in instant retail,
Yeah.
that sounds like pure competitive aggression.
It absolutely is.
Mm.
The fact that Alibaba knowingly took a profit hit because of these price battles is very telling. It signals a corporate strategy that is prioritizing market share, grabbing market share, and building infrastructure dominance over short-term profitability, especially in that one-hour delivery space.
So they're using discounts and subsidies to win customers.
Deliberately, they are lowering consumer prices to capture and keep customers, and that action dramatically raises the competitive stakes for everyone else in that same logistics market. This strategy sets a new, lower bar for what rivals can expect in terms of profitability. When the market leader is willing to sacrifice its own margins to overwhelm the competition, it sends a clear warning shot to every competitor.
That really sums up the tension. They're growing by being fast and investing a lot, but they are paying a steep price for it right now, both in long-term infrastructure and short-term price cuts.
Exactly. And this brings us to what we call the read-through premise. Because of Alibaba's scale, and because they've so clearly shown their strategic focused success in instant retail and this aggressive commitment to AI, the analysis uses these results as a kind of map.
A map to see where the money might flow next.
Yes, and where competitive stress will pop up, and where general market sentiment might be directed across different global sectors. When a company this big makes a multi-billion-dollar strategic decision, the effects don't just stop at their own front door. They influence suppliers, competitors, and peers all over the world.
Okay, so let's start tracing those lines, beginning with the companies that are positioned to gain from this two-pronged strategy. We're moving into Section 2 now. The market beneficiaries. These are the companies grouped into three categories that could see a boost simply because of what Alibaba reported and the choices they're making.
Let's start with Category 1. China e-commerce and discount platforms. This one is linked mainly to that success we talked about in Alibaba's instant retail and their overall revenue beat.
And the reasoning here is really about a confirmation of the market itself. Alibaba's strong revenue shows that Chinese online consumption is still healthy, still has legs.
It does. It shows consumer demand is still robust, even with some economic uncertainties in the background.
And this is good news beyond just Alibaba, right? It sort of validates the whole sector.
It absolutely functions as a validation of the entire sector's thesis. Investors often look at the leader's performance as a proxy for the health of the total market. So when the leader does well, it tends to lift sentiment for other U.S.-listed companies operating in Chinese tech. It reassures the market that, despite the intense competition, the core engine of online shopping is still very active.
And specifically the discount-driven model.
Yes. The strong performance in instant retail, which is often about price-sensitive, high-frequency purchases, lends support to the idea that discount commerce continues to thrive. Consumers want speed and value.
The analysis points to two specific names here. First, obviously, is Alibaba itself, ticker BABA, which gets direct validation for its strategy. But the second one is Pinduoduo, ticker PDD.
Right, and including Pinduoduo, PDD, might seem a bit counterintuitive since they're such fierce competitors.
I was going to say, aren't they rivals?
They are. But PDD is arguably the biggest beneficiary of the discount commerce trend in China. So Baba's results confirm two things for them. One, the market is big enough for multiple giants to succeed. And two, the consumer focus on high-value, low-price transactions, which is PDD's subtlety, is validated by Baba's own aggressive pricing strategy. Baba's success acts like a rising tide, and that can lift the strongest boats in the sector.
Okay, that makes sense. Now let's pivot from consumer habits to infrastructure spending. Our second category of winners, AI chips and data center hardware. And this is tied directly to the other side of Alibaba's strategy, all that capital expenditure.
This is maybe the most direct global connection. The reasoning is purely based on the future demand that Baba's laid out. They've publicly stated they are committed to deploying tens of billions of dollars to build out their AI and cloud infrastructure over the next few years.
Tens of billions, that's not just a rounding error. It's a dedicated, sustained pipeline of demand for some very specialized parts.
That's it, exactly. And think about what you need for a modern AI data center. These are not general-purpose components. You need high-performance, high-density computing, specialized cooling.
Massive bandwidth.
Massive bandwidth. This level of spending by a player as large as Alibaba translates directly into increased demand worldwide for the specific high-performance chips and server hardware needed to build these things. Every dollar Baba spends on this becomes revenue for their suppliers.
So this gives those hardware manufacturers some much-needed visibility into future demand.
It really does. Demand volatility is a big risk for them. So Alibaba's public massive spending plan reduces that risk and just bolsters the whole narrative that AI adoption is driving this unprecedented hardware purchasing cycle.
And the analysis naturally points to the primary beneficiaries here, the leaders in high-performance computing components. So we're talking about NVIDIA, ticker NVDA, and AMD, ticker AMD.
Yes, NVDA is a beneficiary because their GPUs, their graphics processing units, are still the gold standard for AI training workloads. That's because of their architecture and the whole CUDA software ecosystem. When Alibaba spends billions on AI, a big chunk of that flows directly to NVDA for their top-tier chips.
And AMD.
Similarly, AMD is a beneficiary because they compete directly in the high-performance CPU and accelerator market. They provide crucial parts for both servers and emerging AI applications. So Alibaba's commitment is seen as confirming a demand structure that's going to support rapid expansion for both of these firms, no matter where that hardware actually ends up being deployed.
Right, now for the third category of beneficiaries, which takes us back to the cloud, but on a more global scale. Global cloud hyperscalers.
The reasoning here is less about direct hardware sales and more about validating the overarching market thesis. Alibaba's own cloud and AI services segment, as we said, showed strong growth. And that internal success confirms a pivotal global market truth. AI workloads are the main catalyst driving this next massive wave of cloud adoption around the world.
So Alibaba's own success serves as a kind of international proof point for the business models of its big rivals, like Amazon and Microsoft.
Precisely. It reinforces the narrative that this growth driver, AI, isn't just confined to China. It's a worldwide phenomenon, and it benefits all the major cloud providers who have positioned themselves to handle these complex AI workloads. It just confirms that the total market for cloud computing, driven by AI, is expanding at a very healthy rate.
So when Alibaba posts these kinds of numbers, it's almost like an independent affirmation of the huge investment strategies that its global peers have undertaken.
Exactly. It suggests the returns on these massive spending cycles, which we just discussed, are going to be worth it. The market for outsourced AI computing is proving to be enormous, and that's good for everyone at the top of the cloud pyramid.
And the specific names identified here are Microsoft, ticker MSFT through its Azure platform, and Amazon, ticker AMZN through its dominant Amazon Web Services, or AWS.
For both MSFT and AZN, the analysis suggests that investors can look at Alibaba's results as an endorsement of the global cloud economy. The investment cycle is global, the demand is global. Alibaba's strong performance just acts as a leading indicator of sustained, vigorous demand for all hyperscale cloud services. The thinking goes, if Baba can accelerate its cloud growth with AI, then the global leaders with even more mature platforms are even better positioned to capitalize on that same trend.
Okay, that covers the beneficiaries. Let's now turn to the other side of this, Section 3. Market under pressure. These are the companies whose profitability or margins could face some headwinds because of Alibaba's strategy, that combination of aggressive investment and the focus on market share over profit.
And we begin where the competitive intent is the clearest. Category 1, the instant retail rivals in China. The pressure here is direct, it's immediate, and it's financial.
The pressure point being Alibaba's explicit message to the market. We are going to dominate one-hour delivery, and we're willing to use subsidies and price cuts to do it.
They were forcing the market into a very costly fight. And this aggressive posture creates an acute problem for their rivals. The core impact is this immediate, sharp increase in pressure on competitors whose margins are already thin.
Because rapid logistics is just an expensive business to be in.
It's an incredibly expensive business. You have huge fixed costs, those local inventory hubs, routing technology, labor, a lot of costs.
Right.
So when Alibaba, which has this vast pool of capital, decides to use price as a weapon, it puts competitors in a really tough spot.
They either have to match the low prices and burn through their own cash.
Right, and crush their already fragile margins. Or they have to just stand by and let Alibaba steal their market share. For rivals with less capital, this move really threatens their entire growth path.
The analysis highlights two specific names facing this headwind in China. JDBaba.com, ticker JAD, and Data Nexus, ticker DADA.
For JD.com, that's JDD, the challenge is structural. JD has always prided itself on its logistics network. It's a huge part of its brand. But when Baba intensifies the price war and offers similar speed, it directly challenges JD's ability to grow profitably. They're forced to get into a low-margin race to keep up.
And data nexus.
For data nexus, DADA, the pressure is arguably even more direct. They operate precisely in that local, on-demand retail and services market, the exact segment where Alibaba just announced its intention to spend heavily and discount aggressively for dominance.
Okay, let's move to the second category under pressure, which expands the scope beyond China, value and marketplace platforms. This group faces a less direct, but maybe more pervasive strain.
The pressure point here is the continuous global drag created by the collective strategy of Chinese giants Alibaba and his peers to push deep discounts and expand their cross-border logistics. This influx of low-cost goods into the global market starts to set new consumer expectations for price.
And this chips away at two vital metrics for global rivals: consumer wallet share and overall pricing power. How does that work in practice?
Well, wallet share is simple. It's the amount of money a customer spends on your platform versus another. If consumers can consistently find similar goods for much cheaper, delivered faster and faster via Alibaba's network, they'll naturally shift their spending.
And pricing power.
Pricing power erosion is more subtle. When a customer knows they can find something cheaper on an aggressive competing platform, it just limits the price that a seller on any other marketplace can realistically charge for a similar item.
This affects anyone who operates a marketplace focused on non-essential or value-driven goods.
Yes, because it raises the bar for what's considered a good value while driving down tolerance for higher prices.
The analysis points to two U.S.-listed companies as being vulnerable here: eBay, ticker EBAY, and Etsy, ticker ETSY.
Right. And while both of them target slightly different niches, eBay is broader. Etsy is focused on handmade and unique items. They are not immune to these global pricing pressures. If a consumer can buy a novelty item or a household gadget at a steeply discounted price from a subsidized cross-border platform, it ultimately puts downward pressure on what sellers can charge on eBay or Etsy for similar kinds of merchandise.
Which limits their ability to increase platform fees or for their sellers to maintain healthy margins.
Exactly. It restricts their pricing power and their long-term financial flexibility.
All right, finally, let's get to the third category of companies under pressure. This one requires more of a comparative analysis: the high-cost convenience delivery players, specifically in the U.S.
This scenario really challenges the long-term profitability story that U.S. delivery companies have been trying to tell investors. Alibaba's operational effectiveness provides a rigorous, high-volume benchmark for what's called unit economics that is just very difficult for U.S. peers to match, given their different operating environment.
So the core question this raises is, if Alibaba can successfully show that one-hour logistics can scale with superior unit economics, making a sustainable profit per delivery, what does that say about the financial durability of U.S. companies that are still struggling to show consistent margins?
It becomes an extremely tough comparison. U.S. delivery companies are dealing with high-cost labor markets, low-density suburban sprawl, all things that make efficiency harder to achieve.
Their business models rely on high service fees and subscriptions to try and cover those costs.
Right. But if Alibaba, operating in the world's most demanding e-commerce market, can prove the unit economics work well enough to then turn around and fight a price war, it suggests the high costs and thin margins for U.S. players might not just be a temporary growth phase.
They might be a structural flaw.
They might be. A flaw inherent to the combination of high U.S. operating costs and current tech. So investors will look at a DoorDash or an Instacart and ask, why can this massive Asian peer achieve the efficiency needed to win a price war when you can't seem to achieve sustained profitability even at your current unsubsidized prices?
This forces investors to be a lot more critical of the proposed paths to profitability for these U.S. firms.
Precisely. The analysis identifies DoorDash, ticker DASH, and Instacart, ticker CART, as the specific names facing this kind of pressure. For both DASH and CART, their models are based on offering convenience at a premium. If the global standard for convenience delivery, as set by these capital-rich players, is driven by aggressive price competition, it severely limits the headroom for Dash and Cart. They can't easily pass along their rising costs to consumers without risking losing business. The validation of this aggressive low-margin model in Asia just makes the path to profitable scale for the U.S. companies look dramatically steeper.
To bring all this together, the recent performance from Alibaba really paints a picture of a strategic duality. On one side, you have massive tech investment that guarantees global demand for high-end hardware. That's a tailwind for companies like NVDA and AMD. And on the other side, you see this hardening competitive landscape where market share, especially in 1 hour delivery, is being pursued ruthlessly at the expense of short-term profit. And that creates palpable strain for competitors like JD and DoorDash.
Right. The essential knowledge for you to take away from this is the direct tension between those two priorities. The capital spending in AI is a cooperative, market-expanding driver for chip makers like NVIDIA, ticker NVDA, and AMD, ticker AMD. But conversely, the fierce competitive spending in consumer logistics creates an antagonistic, margin-compressing environment for companies like DoorDash, ticker DASH, and DataNexus, ticker DAED. I guess the question that remains, and it's something for you to think about, is whether the profit generated by the AI investment boom can ultimately subsidize these destructive price wars in consumer delivery long enough to create global monopolies. And, what that might mean for the independent existence of today's smaller market players.
As a crucial reminder, all the information presented in this discussion reflects a breakdown of existing analysis concerning Alibaba's performance and its market connections. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author of the analysis we reviewed. Thank you for joining us for this analysis on breaking news to trading moves.